ought to be worth $80 million. That's what you would price it at. But under this crisis, because everybody was scared, it was only priced at $50 million. The only person that would buy it was somebody that would want to steal it. Why didn't people like BB&T step in? We had plenty of money. We knew the mortgage was worth $80 million. Why didn't we step in and buy those mortgages? And if we'd all stepped in, we'd driven the price back to $80 million. Simple reason. We couldn't take the accounting risk. We knew what the economic value of the mortgage was, but we didn't know what the accounting value. What if this panic continued at the end of the next quarter and we'd have to mark it down and we'd have to raise capital? Because here's the problem. If you go back to that $100 million mortgage, if you wrote it down to an economic value, the bank would lose $20 million, which would destroy $200 million worth of liquidity. But if you write it down to the distress value under this crazy environment, you had to write it from 100 to 50 million, and the bank would lose 50 million times 10 or $500 million worth of liquidity would disappear. So a lot of the destruction in liquidity was an accounting system that had nothing to do with economics. There are all kinds of other problems with fair value accounting, but an interesting thing to think about. People don't realize this. The United States does not have a private accounting system. The SEC owns the accounting system. It's a government-driven system. I don't know of any business of any size that runs their accounting, their actual internal operations based on GAAP accounting. We all run our own internal operations and convert it to GAAP accounting. So it's not a market-selected system. Unnecessary cause of the crisis. Pick-a-payment mortgages played an important role in the crisis, and probably most of you have heard about a pick-a-payment or negative amortization mortgage. That's where the interest on if you go buy a home and the interest is about $1,000 a month and you only pay $500 a month. So each month your mortgage gets to be bigger. Interesting product, right? You owe each month. Very popular in places like Southern California, Southern Florida, Metro DC, where house prices were appreciating very rapidly. And the theory was to go in and leverage yourself to the maximum, buy as big a house as you could possibly buy. The big players in the pick-a-payment mortgage market were people like Golden West and Washington Mutual and Countrywide, all which failed, and all which financed these mortgages using FDIC insurance. Without FDIC insurance, there couldn't have been a pick-a-payment mortgage market. BB&T chose not to be in that business, and I'll come back to this in a couple of minutes, not over economic considerations, but over ethical considerations. We weren't smart enough to see the crash that's happened in real estate, but we knew real estate prices weren't going to keep appreciating 10 or 15% a year forever. It's mathematically impossible. And we knew that if we made these pick-a-payment mortgages, we were setting up a lot of people to get in trouble in the future, particularly young people, because they were going to end up owing more on their house 5 years down the road than it was worth. Even though we could make those mortgages and sell them in the marketplace, one of the fundamental commitments in our mission is to help our clients achieve economic success and financial security. We expect to make a profit doing that, but we are fundamentally committed to doing the right thing for our clients. And so we chose not to get into the pick-a-payment mortgage business, not over economics, but over ethics. And interestingly enough, and I think there's a lesson in that turned out to be very good economics in the long term. Here, and this I'm going to try to connect at the end to what the implications of some of the things we're doing today. There are many times long-term consequences to policies that sound good in the short term. And it's an interesting story about that. Some of you that are my age may remember that for many, many years, home financing was primarily provided by the thrift industry, savings and loan industry. When I went and got my first mortgage, I went to a local savings and loan. I had to put 20% down. I financed 80% for 30 years. And 95% of the people in America did that. The thrift industry dominated the home finance business. What happened to that business? How did we get from there to where we are today? Well, interestingly enough, the thrift industry was systematically destroyed by government policy. And it really started with Lyndon Baines Johnson. Johnson wanted to have the war in Vietnam and the war on poverty, the Great Society, but he didn't want to tax people because that wasn't popular. So he got the Federal Reserve effectively to print a bunch of money to finance that expansion. That led to massive inflation in the early 1970s and through the 70s, and then in the early 1980s, in order to stop the inflation, the Federal Reserve, to correct its own mistake, raised the prime rate to 21, 22%. These savings and loans have been making fixed-rate mortgages, financing them with certificates of deposit that are variable rates, and many of them failed in the early 1980s. Then the few that made it through that cycle got some help from their friends, the regulators. What's called the FSLIC, that's now the FDIC, and they got two interesting pieces of help. One, they were strongly encouraged to hedge their home mortgage portfolios. You can't hedge a home mortgage portfolio because there are no prepayment penalties. So when interest rates fell, they lost billions of dollars. And then they were strongly encouraged to get into the commercial real estate lending business because they couldn't make money, quote, in the residential business. And they got into financing shopping centers and office buildings where they had no expertise. And we had the commercial real estate shake out in the early 1990s, most of the rest of the thrifts failed. That's when Freddie Mac and Fannie Mae fill the gap in the home mortgage business. Now, what's interesting, the reason they filled the gap, there were many other private competitors like BB&T that would have loved to have been in the home finance business, but you can't compete against the government. You see the same thing in healthcare. Remember, Freddie Mac and Fannie Mae are leveraged 1,000 to 1. They have a government guarantee on their debt. They have the lowest cost of capital. They basically practically drove everybody out of the home mortgage business. Nobody else could compete against them. They took over the A home mortgage business. And then when Bill Clinton comes along and says you got to get into the subprime, the affordable housing business, they had to go out and find a way to get affordable housing loans because they weren't really in the high risk business. So they went to people like Washington Mutual, Countrywide, and said, give us these high risk mortgages, and local brokers. And the whole model changed. In the old savings and loan business, and they had been in business for 60 years and had very low loan losses, because they made the loan and they kept it. So they were very concerned about the risk. In the broker model, however, the broker makes the loan and sells it to somebody else. He's got a huge incentive to sell the mortgage no matter what the risk is. And that led to a lot of fraud in the industry. And the way the fraud, it was a very subtle kind of fraud. Client comes in and says, I want to buy a house, and I made $60,000 last year, when he really made $50,000. The broker says, well, didn't you really make $70,000, and I can get you a bigger house, and it's a good time because home prices are going to go up and up and up. And then all that gets securitized and misrated by Standard & Poor's, Moody's, and Fitch, and sold into the capital markets when the rating agencies failed. And that's where the investment bankers jumped in to create instruments to make that happen. Now, a lot of people say the investment bankers were greedy. Maybe they were greedy. My personal opinion is they were dumb. A lot of them lost their jobs. A lot of them lost a lot of money. They were very pragmatic and very short-term oriented, and we'll come back to that in just a second. What did they do? And this is where you get into this esoteric stuff. It's not quite as esoteric as it sounds. You've probably heard about CDOs and SIVs and CDO squares. They are complex, but let me try to give you a real simple example. The idea of a CDO is actually a legitimate idea. It was actually to reduce risk. And the way it got started is the bank made a $500 million loan to General Electric. Even though General Electric is a good company, they didn't want to hold that whole risk, so they sold parts of it into the capital markets to reduce the risk. Around that model, a number of these investment banks were creating these mortgage instruments, and maybe on average the mortgages were a B rated. I'm trying to make this simple, B rated instruments. They said, well, you know, there's some people that like to buy an A, and some people that would be willing to buy a C because they get a higher interest rate, so why don't we make these Bs into A, Bs, and Cs? And the way they did that was creating something they called a tranche. And the way a tranche worked is the Cs would take the highest risk, first loss, the next losses would go to the Bs, and theoretically no losses would ever get to the A's. They ran into a couple of problems. First, the A, Bs, and Cs were actually D minuses, Fs, and F minuses, so that was a big problem. The second problem is, you call this greedy, call it stupid. Bernanke inverts the interest rates. The banks don't have any assets they can hold, they can make money on. So they decide to hold the Cs. Because after all, the Cs are pretty good risk, right, from the Standard & Poor's, Moody's rating. And initially, people like Merrill Lynch were making a fortune. They're selling the A's and B's in the capital markets, holding the C's, making a fortune. And then when the market starts declining, it turns out these C's are F minus and they lose 100 cents on the dollar. So Merrill Lynch goes from making a fortune to going broke in a very short period of time. How about credit default swaps? Sounds esoteric, but actually all it is an insurance policy, a simple kind of insurance idea. Goldman Sachs is sitting on a bunch of B-rated mortgages. Under the SEC capital guidelines, Goldman Sachs can keep a whole lot less capital if those mortgages become A's. So they go to AIG, a large insurance company that's AAA rated by Standard & Poor's, Moody's, and Fitch, and say, hey, will you rate this, and we'll pay you some insurance policies, and by getting this bond insured, it goes from a B to an A. Legitimate idea. Of course, the ratings were wrong. The A's were F's in terms of Standard & Poor's, Moody's, and Fitch, and AIG's own models fail. Happen in that regard. What's interesting is why do we choose to save AIG? Now, AIG is one of the largest insurance companies in the world, and the protection of their insurance business makes some kind of argument, but all the evidence is that all their insurance subsidiaries were sound. So even if the parent company had failed that was in this high-risk business, probably none of us would miss them. The people that might have missed them, however, were the people at Goldman Sachs, who were huge counterparties to AIG. Now, Paulson, who's as far as I know, an honorable person, had spent his whole life at Goldman Sachs, had $500